Mr. Joe Brady, welcome into the show.
Matt, thank you. Good to be here.
So we've been, geeking out on commercial real estate, retail, office. There's all kinds of, stuff going on in the global landscape, which obviously impacts the domestic landscape, which impacts so many different aspects of, real estate investing, commercial asset classes, different markets around the country. So I know we're going to unpack a lot of that. We're going to unpack your book, which covers a lot of that. But for those that don't know who you are and your journey and background in commercial real estate, where'd this all begin for you?
It all began at the University of North Carolina at Chapel Hill. And so I'm a kid with an electrical engineering degree who kind of looked out and said, I don't know if I wanted to use that or do that. I wound up getting an MBA at Chapel Hill. It's now called the Keenan Flagler Business School, and had two fantastic professors. One, Mike Miles, who was the guru of development, and another, Dave Hartzell, who was the guru of real estate finance. In fact, he was one of the early guys with Louis Ranieri in creating mortgage-backed securities. So just kind of opened my eyes. I wound up spending a brief bit of time in corporate finance at First Chicago, which was later acquired by JP Morgan. And then moved over into the retail side. So I spent a majority of my 35 years on the retail side of the business. So of everything from managing a portfolio of Burger King assets to actually becoming a Burger King franchisee. So early in my career, I was kind of the Doogie Howser of Burger King franchisees with a partner. We had seven stores. And for young people out there, I think it's really important for you to try things and get uncomfortable, but also realize what you don't want to do. So after about the third double Whopper with cheese thrown at my head in one of the stores, I figured, you know what? I love everything about buying dirt, building buildings, kitting them out, everything until that moment when you turn the key and the public comes in. Then I'm out, right? And I kind of vowed to myself, that's what I'm going to do, and wound up on that path. So I wound up joining a company called Hollywood Video back when the home video rental industry existed. And with a team, we wound up opening 2,000 stores, trying to be number two to Blockbuster's, significantly number one position. But that was such a cool opportunity because I wound up doing deals all over the U.S. I wound up working with brokers all over the U.S. Even Minot, North Dakota in January, right? It was that somehow was fun. But in the year 2000, the music stopped. Hollywood Video would be gone within a year. And so I had three other partners. We started a company called the Standard Group, which was this outsourced retail real estate company. Our biggest client was T-Mobile, so we wound up opening the first 2,000. With that, I wound up selling the business to JLL and was on the corporate side at JLL for about 9 years. So I've done the entrepreneurial thing where, tough to sleep at night. You're going to make payroll. I've had a couple of events where we sold businesses, which is a good thing. But at the end of the JLL run, I wound up going over onto the client side at Walgreens and becoming the head of real estate for Walgreens. So I showed up in early 2016, 150 million square feet of real estate, literally every type of commercial real estate you could think of, from data centers, distribution centers. Of course, there are 9,000 stores, retail stores, but it's surprising, Matt. So much of what was happening was being managed on an Excel spreadsheet. And when you think about $4 billion of annual OPEX on an Excel spreadsheet, mistakes happen, and everything was kind of the law of big numbers there. So I spent a lot of time dragging the whole department into modernity, building the right technology. I'm excited to talk about technology with you as well. But we were able to save a lot of money and actually do a number of things in the capital markets to create actually a profit center within the real estate department at Walgreens, which was kind of cool. And then finally, I spent the pandemic, working for a company called the Instant Group, sitting at the front row of this whole tectonic change that happened because of the pandemic. And the Instant Group is part Airbnb of flexible office space, part interiors developer of office space, and then part consultant. So it was super, just a tremendous amount of fun. So that's a little bit of my background. So I always say I've sat at every seat at the table for a real estate deal and a development.
And talk a little bit more about, just from your perspective, which seat did you like the best and why?
It varied based on how tired I was. On the entrepreneurial side of things, you're going 24/7, taking on a lot of risk, building up something. And when we sold the Instant Group, there's a lot of the fill in the blank and then group in my life. When we sold the Standard Group, when we sold the Standard Group to JLL, we closed January 3rd, 2008. And so, that was super lucky, right? Blind squirrel finds nut. And so it was great to have a port in the storm. It was great to have a global platform, a publicly traded company, one of the top real estate companies in the world. And that felt good. Where I am now is I love building teams, and I love building buildings and developing buildings, acquiring buildings that are helping to contribute to healthy communities. And so we're having a lot of fun, particularly on the retail side, but we're also looking at hospitality and hotel and attractions as well that are contributing to building healthy communities. So I'm fortunate, my kids are grown in their young adulthood, empty nester. I really like my wife. We're actually, we're having fun being empty nesters. And so, I have this time now to invest and be a little bit more strategic, take on a little bit more risk, but deliver some really fun and interesting projects.
Well, let's talk a little bit about, some of your asset classes of expertise, and maybe a little bit about, I know the book talks about, understanding the history to also give you some context to the present, potentially foreshadow some of the future. Maybe talk a little bit more about your scientific approach to analyzing assets and how you look at, these asset classes through your own lens that other people might be able to get some insight into how you approach deals.
Yeah, I think it's important to study history and to realize that in a relatively short order, we went from the farm and field to the factory to the office, to the cubicle farm, kind of coming full circle. And when you think about, I think about my grandmother, Brady, Esther Brady, great lady. She died at 101 and a half. She actually danced at her 100th birthday, but she was born in 1902, and I used to talk to her about everything that she saw and what changed during our lifetime. And my thesis in the book workshop is really about how accelerating technology has been changing consumer behavior with the ultimate impact on commercial real estate, right? So, not to go way, way, way back, but you think about post-World War II, baby boomers were flourishing. The GI Bill led to, the great American middle-class dream. We were in a car culture. Suburbs were booming. The first malls were coming out of the ground. The first one in the Minneapolis market. And, next thing you know, what used to be the tried and true department store started bit by bit getting dismantled into the bookstore junior anchor box, into the electronics junior anchor box, into the durable goods, into fast fashion, et cetera. And all of that was in reaction to how the consumer was voting with her wallet. And it's, and if we follow Moore's law, right, started back in 1964, Gordon Moore, one of the co-founders of Intel, had this idea that every 18 to 24 months, we would be able to double the power on a chip, the number of integrated circuits, and cut the cost in half. So when you double something in power and cut the cost in half, and you do that over 60 years, you get this exponential curve, and that's the amount of change that we're going through right now. So as I think about my primary focus is on retail, but it's really consumer-led retail, so or consumer-led businesses, and so there's some other elements that can fit into just saying retail, but because there's a lot of experiential businesses out there that are flourishing, that are primarily experiential, and then they retail as well. Hasbro, for instance, is doing some really cool stuff. Nickelodeon is opening hotels. Legos on its own is just this extraordinary brand, right? So, I just think this accelerating technology really caught up with retail about 10 years ago. And it's no surprise that in 2007, the iPhone came out. By 2010, we started hearing the first glimmers of a retail apocalypse, where we were all going to be like that character in Wall-E. If you saw the movie, sitting back in a reclining chair, drinking a big gulp, and everything was just brought to us. Like we were never going to go to a brick and mortar store again. And all of that was clickbait, right? It just never came to be. It absolutely didn't. Now, did e-commerce increase as a percentage of total retail sales? Absolutely. Did this notion of omni-channel retail emerge? And did the consumer decide that she wanted to use a brand on her own terms, meaning buy online, pick up in store, order online, have delivered to home? I mean, whatever, have it delivered to home and return it to store, which is, certainly part of that cycle. We definitely saw that happen. And the retailers who listened to their customers, to their consumers, who remained relevant, were the ones that continued to do well. The others are on this dust heap of history. In fact, this month, September of 24, we saw the last Kmart in the United States close, right? Wow. So not relevant. But then you look at an Apple store, which, again, wasn't even a retailer, and now they are producing some of the highest revenue per square foot of any retail concept anywhere, right? It's just extraordinary how we've really adapted and really moved on.
Yeah. Now, to your point around, retail and office kind of going, and every asset class goes through its ebbs and flows, and it's, different phases of, different market cycles. What are your thoughts around how retail has managed over the course of the last decade or two? And what do you foreshadow as, some of the threats or opportunities in that asset class going forward? And maybe we could talk a little bit more about what office is going through right now and where the threats and opportunities might be there as well.
Yes. I would say that the retail industry benefited in a really strange way during the pandemic because they started limiting and controlling the amount of inventory they had on hand. So for the first time, and you'll remember during the pandemic, you weren't necessarily seeing these like fire sales of merchandise because the retailers were able to pull in their sales pretty quickly after the initial shock. The fact that we've seen this run up in interest rates, and now that we're going on the decline, and the fact that there was a spike in inflation, and the fact that there was this concern about, are people actually going to go to a store or not? There was a air gap of time in terms of when net new retail real estate was being built. In fact, over the last 10 years, there's been over 100 million square feet of product taken out of the supply side. So where do we stand now in retail? Well, you've got some really extraordinary retailers that are looking to grow, whether it's Whole Foods, whether it's Target that just announced they were going to open their large 120, 130,000 square feet. You have some of the cool, hot food and beverage concepts. You think about what Chipotle is doing. You think about Kava. You think about Shake Shack. You think about Raising Cane's. Starbucks is still growing mightily. They don't have the existing supply in order to penetrate. So they're looking for net new development. Now we're starting to see, the wheels move. We're starting to see on the investment sales side that existing assets are starting to trade, which is good. And that gives developers enough confidence to say, okay, I'm ready to put my time and my capital into net new growth. The other thing that's happening, Matt, is this, I would say, demographic shift, population shift. So we are seeing, net exits from places like New York, California, Illinois, Chicago. My wife and I are guilty. 3 years ago, we moved from Chicago to Florida in the Jacksonville area, which, by the way, is a cool area, a completely unpriced trend. Well, it's getting more and more priced. I should probably keep my mouth shut. But it's a super cool area. And as an example, there's 1,200 people a day moving to Florida. And when you think about trying to fill up, plug more people into Miami-Dade County or Broward, it's kind of getting full. And so we're seeing the outer rings of Tampa, the outer rings of Orlando. We're seeing Jacksonville. We're seeing, Gainesville is a college town. Tallahassee is a college town and state capital. We're seeing all of these areas expanding, and there's great opportunities. So, I would say, for your listeners, would I be running into Muncie, Indiana right now? All due respect, if you had the chance to do something in, say, Jacksonville, Florida, you've got demographics or destiny, as they always say, and so there's a lot of power there that's pretty obvious and that we should be acknowledging.
Now, what lessons from kind of the retail sector do you think can be applied from your experience to the currently very troubled office market?
Yeah, office is so interesting, right? You think about the frequency with which an owner or an investor in office buildings operates at. And it's typically at like an 8 to 10 year term, right? Like the frequency of what they're operating. They want to build a building, they want to fill it up with 10-year leases, and they want to go play golf. And because of the technology acceleration we talked about earlier, many of the businesses are operating at frequencies of, a year, or maybe even a half a year, or maybe even a quarter. Like you think about some of the cybersecurity businesses that are going in there. They don't know what kind of bad actors they're going to be confronting in 6 months, let alone in a year. And when you think about this massive technological platform shift that is AI, those businesses are having, how can you project what's going to happen in 3 years, let alone 5 years, let alone signing a 10-year lease? So office needs to understand that the ribbon cutting, right? You build the building, cut the ribbon. That's the beginning of the process, not the end. So the office asset class needs to understand that agility and flexibility are vital, and they have to look at their tenants, and then the corporate occupiers have to look at their employees as the new consumers. And that's a paradigm shift that many are having a really hard time doing. Now, don't you find it interesting that the company that totally upended the retail industry, Amazon, is the same one now saying everyone back in the office 5 days a week?
Yeah.
Now, there's probably more to the story than any of us knows. But I do know that if part of your intention is to drive culture and you mandate people back into the office, there's nothing that crushes culture and trust faster than a mandate, right? Reactance sets in. What we learned, and this is a really important parallel, or a connection, a bridge between retail and office, is the consumer in retail really embraced this notion of agency, autonomy, and optionality, and how she voted with her wallet. And so when you think about having that agency, optionality, and autonomy, we've been operating that way, spending our money for the last 10 years. The pandemic created this tectonic shift to where for 2 years we were all at home, and it was really disconcerting when people were saying, hey, when are they going to return to work? As if people weren't working through the pandemic. In fact, it was been proven that many worked longer and harder than they did when they were commuting an hour each way and sitting in a cubicle in front of a screen. But we are all the same people who have gotten used to agency, autonomy, and optionality. In other words, using brands on our own terms and having it available in an omni way. We now are looking at our work, assuming that we're in the knowledge industry, the keyboard economy, and we're saying, why are we working Monday through Friday, 9 to 5, when that's a industrial era construct, right? That's how factories worked. And we know that work it is now something people do irrespective of place in the keyboard economy. That's why I named the book Work Shop, because shop went from a noun. 20 years ago, if you wanted to spend money, you'd have to go to a shop, right? And you would then shop in the physical place. But as we've seen, shop has become a verb. It's a thing we do irrespective of place, whether it's online, on our phone, in the store. Work, likewise. Matt, if I said to you 5 years ago, hey, Matt, I'm going to work and I'll meet you afterwards, work and office were synonymous. They are now decoupled, right? And so what else can the office asset class learn? Well, there has to be a purpose to come into an office. There has to be some level of purposeful presence over passive attendance. And that means a number of things. I had a client when I was at the Instant Group talked about this great phrase, and it's always stuck with me. It was that on-site needs to be the new off-site. And when you think about that, it's pretty enlightening, because in order to get people to come and gather, you almost need to have an agenda. Maybe a guest speaker, maybe there's some food involved, certainly a social hour. Maybe there's a problem statement people can work on. And just like in retail, when people were going through the retail Armageddon saying, no one will ever go to a retail store again, the same clickbait's happening now. Like, no one's ever going to go to an office again, or, they're just going to work at home. That's a fallacy. What we saw in retail is that right now, e-commerce represents about 15% of total retail sales. And total retail sales are $3 trillion. So that's a big number. What's interesting, and ICSC we're in our third round of research called the Halo Report. And this research was done using MasterCard credit card data. And what we found was that when a retailer went into a new trade area and built brick and mortar, their online sales went up 6 to 8%.
Interesting.
And stayed there. What's even more interesting is when that same retailer closed a brick and mortar store, their online sales went down 12 to 14%. So the consumer's speaking pretty loudly there. And so for the office asset class, is the office location in a healthy community? Is it set within a live, work, play environment, healthy ecosystem that has a 24/7, 365 vibe to it? What we're seeing in certain pockets of certain cities, like Chicago in the Loop, like the financial district in San Francisco, parts of Seattle, parts of Washington, D.C., are areas that are what I call monocultures, right? They're just work. It's just office towers.
Yeah.
And even before the pandemic, those were getting, 4.5 days a week, daytime pop. Now they're getting 2.5 days a week. And food and beverage and other service just can't survive on that. And so we're seeing this bit of a doom loop happening in some of those areas. And so, if you're thinking about office, there's only so much office to residential conversion that can happen.
Yep.
There are some limitations, but thinking about employees as the new consumers relative to an office building will become really, really important going forward.
That's a brilliant way of looking at it, right? And from what I'm hearing, you're talking about creating that stickiness factor to, and you said a key word earlier, experiential, right? It's not just going there to work, it's going there to socialize, to work, to maybe find some inspiration, some motivation, some education. Maybe there's some amenities worked in. You said F&B, right? It's almost becoming somewhat of a hospitality programming play around an office environment. And I know you talk about in the book this new collar economy. Hybrid work models, right? We've talked about kind of, consumer behavior changing. We're talking about office and work culture behavior changing. So those are some of the strategies that you're starting to encourage people to explore more around how they model their investments based on some of those things.
Exactly. I think, understanding that we're in an era of consumer primacy, and that omni-channel retail and hybrid work are two sides of the same coin. That can help with your thesis as you're understanding whether you're looking to build something net new out of the ground, you're looking to acquire a distressed asset, and you're thinking about repositioning it. Those are really important aspects.
Now, talk a little bit about, technology. And, I think there are maybe some common misconceptions that people have around, technology being either a really big net positive or a net negative. What's your overall perspective around how technology is transforming and evolving and disrupting commercial real estate, and what it's going to look like as we go forward with technology significantly, enhancing year over year in ways that people just can't necessarily keep up with?
Yeah, that's a great question, a great topic. And what we need to acknowledge is that we've gone through this series of technological platform shifts where tools have given us a higher degree of productivity and efficiency, and cut the cost of producing as a part of the process, right? So, when we were pushing a plow in the field, we weren't as productive as when we had tractors, right? And then in 1900, and this conversation also always dovetails into the whole idea of, like, you're taking my job, right? And I'm going to be displaced. But in the year 1900 in New York City, there were over 30,000 people employed shoveling horse manure, because we had a city filled with horse and buggies, and that was it, right? And 15, 20 years later, it was a fraction of that, but those people then moved into call it the auto assembly lines, right? And they had higher paying jobs, and it was safer and all this other stuff. So where are we today? Like this latest platform shift that's really around AI is extraordinary. And if you think about how extraordinary it is, NVIDIA in April of 2023 was worth $1 trillion. By July of 2023, it was worth $2 trillion. And by September of last year, it was worth $3 trillion, right? That's acceleration and speed. What does that mean for real estate? Well, for us, for those of us who own, develop, and engage as practitioners in the real estate industry, I think there's going to be some really cool opportunities to understand our portfolios better. I think there'll be opportunities with AI to, to all of us have digital twins of every asset that we have, right? That allows us to understand and access information readily. So with a digital twin, and if we had a rooftop unit that was failing because we're monitoring it, the digital twin would tell you exactly what your serial number was, when you purchased it, and whether it's under warranty or not. And that's information that you can communicate to your repair folks, and boom, you're getting things done a lot faster. The more interesting thing for me is when you start thinking about legal documents and data. When I was at Walgreens, we had over 14,000 leases, and they were physical. They were, wet signature, physical leases. We had a hurricane come through in, I think, 2017 in South Texas, and there were 100 stores that were impacted. I had to get a team of 8 people, and it took them 2 weeks to pull all of the leases, to physically read through them, to come back and collate a report to tell us what our exposure was in terms of rebuilding and so forth. I did some meatball math on that. It cost about $16,000 of labor and 2 full weeks. Now, assuming that you're able to ingest all of those leases into a data lake, and you have the right systems, which are, some are there now, some are better than others. It would be a matter of keystrokes, using your real estate bot overlooking all of your data. And so that answer would come in about 27 seconds, right? And that's a big difference in how fast we'll be able to see into our portfolios, make better decisions. We'll be able to track every expense, every window, all the asphalt costing. Like, the idea of estimating jobs, we'll be able to look at and have the history of the last 10, 20, 30, I'm talking in terms of a Walgreens scenario now, or it could be an office building where you have 3 or 4. You'll know exactly what you've spent and when you spent it, and sort of be able to have clarity into construction cost estimating. I think that's another area. I guess the final thing, and I talked a little bit about this in terms of the new collar economy, where technology is changing things rapidly. Do you really need a college degree to be an AI prompt engineer? Well, we don't even know what an AI prompt engineer is, right? I mean, but that's a job that's emerging. Yep. And so it goes back to the speed with which the tenant companies are operating compared to your longer term outlook of 5 to 10 years for owning an asset. So really understanding what kind of business, what business are your tenants in? Can you think about a tenant mix in merchandising within your office building, the same way a retail developer would think about the merchandising within their shopping center? You may want to make sure you have a law firm, right, that's probably going to keep doing what they're doing in sort of the same ways for 10 years. And then you may have Palantir or some other really cool high-tech companies that are coming in there too. So thinking about your tenant mix in terms of portfolio theory could be another really important area.
Yeah, I mean, AI is just it's blown my mind over the last few years. We do workshops in the office with the team now because it's become such an amazing asset from an efficiency standpoint, from, like you said, you can go in terms of legal, you can go in terms of scraping the internet and pulling stuff that would take, one person weeks to gather. You can put a spreadsheet in there and tell it to, either create a formula or fix a formula. I mean, there's so many different ways. I see people putting leases in there now and having it summarize the lease and all the key points and draft amendments. And now, of course, right, with technology, there's always that. I use the 80-20 of like, hey, it's going to do probably 80% of the heavy lifting. Make sure you do the last 20, to double check it. But so many great ways that, it can be leveraged in real estate to, create profitability, create more efficiencies. What is your predictions for the next big disruptor in commercial real estate?
The next big disruptor in commercial real estate, well, I'll jump to it in a second, but I still think we haven't gotten our hands around the current disruption.
Yeah, let's talk about that.
Yeah, just around AI, the data centers in which the GPUs exist. The amount of energy needed to produce the outcome from a simple, AI query is a matter of 100 times more energy costing than just a typical Google search. So, we are coming up and having some serious challenges relative to sources of power and cooling water. I just saw, and I grew up outside of Philadelphia, so I just saw this past month that I think it's Constellation Energy is working with Microsoft to bring 3 Mile Island back on line, right? And so as a kid, hearing a potential meltdown, I still have some PTSD from it, but I'll be okay. But think about it, like we have to start embracing new types of energy production. Nuclear kind of makes the most sense. It's scary for a lot of people. Yep. It wasn't that long ago that Fukushima in Japan had an issue, but we have to start thinking about alternative ways. So in order to really allow this AI platform shift to run, we're definitely going to need to supply it with the infrastructure that it needs.
And is your theory on that specifically that's an opportunity for investors and or developers who can house and source that kind of energy, footprint or infrastructure for those types of organizations and companies that are going to continue to expand into that space?
It certainly is. And we're seeing more and more integration in commercial real estate than we ever have. And so, we're exiting a period of time where, Matt, you and I would talk about just the retail asset class or the multifamily resi asset class or data centers or vital infrastructure, because they're now more interrelated than ever, right? The healthy ecosystems for healthy communities have live, work, and play. So, we've seen a lot of malls decoupled and demalled, and we've seen multifamily residential emerge. We've seen flexible office emerge. So I guess what I'm saying is if you're Blackstone and you're in charge of the data center business, which has now become one of the biggest businesses the firm has, you're spending as much time thinking about the necessary power in order to really energize those data centers than the physical structures themselves, right? The GPUs are expensive, the buildings are what they are, but unless you have the power to make it all work, you're gonna be suboptimal.
Yeah, that makes sense. Now, talking a little bit more around communities. Mm-hmm. and how you're seeing successful investors really kind of lean into community first, real estate investment strategy second, or maybe the opposite. What do you think is the right approach for thinking about how your asset and the community integrate in together? And how should investors be looking at that when they're, talking about making their own investments in certain communities or choosing not to based on those communities?
We have two really good examples, and one is in one of the more unlikely cities. It's not usually people's top 10 when you say, let's look at Detroit, right? Because Detroit has gone through a tough time from decline in the auto industry, part of the old Rust Belt. But Dan Gilbert of Rocket Mortgage, has invested over $5 billion working with the city, with his company called Bedrock, to completely revitalize downtown Detroit to the point now where it's thriving. Net inflow of people. You've got a sporting venue that's anchoring an entertainment complex that's brought back office that then is allowing for more residential. And so it takes a public-private partnership. It takes big dollars. And I think, you can, if you're not a billionaire investor, you can watch where the billionaire investors are really taking the leadership position and then invest in behind them in opportunities. But Detroit is a great example. Downtown Tampa, which heretofore was sort of an afterthought. Many people didn't think about downtown Tampa. Everyone wanted to be on the bay, or and so we saw sort of this suburban growth happening around Tampa. Jeff Vinnick, formerly of Magellan Funds at Fidelity, moved to Tampa, bought the Lightning, the NHL franchise, built an arena, and with his partner, Cascade Investments, which is Bill Gates' investment arm, started this brilliant idea, again, public-private, taking big dollars to say, we are going to transform downtown Tampa into a live, work, play environment that will have healthcare, it'll have education, hotels, residential, sports, and the retail, of course, followed. The first Publix opened in the downtown area. So those are really, really good examples of major cities that have gone through this transformation. Another that's happening right now in my neighborhood in Jacksonville is Shad Khan, who's the owner of the Jacksonville Jaguars, is leading a major renovation. New stadium is on the way. Again, the city's participating in that. The organization's building a new Four Seasons, redoing shipyards. So you're taking a city which, if you go in downtown right now, you kind of look around and say, wow, this place has great bones. Somebody should do something with it. Now, there's a team called Gateway Jacks that's backed by two high net worth families that are investing in downtown buildings. And, you're seeing it happen, but it takes big leadership. It takes an open city government or municipality that says, yes, we need to do this. And then there's opportunities to backfill behind it. What are the fringe neighborhoods that are going to benefit from all of that great investment that's happening? Those are places where you can stick your toe in and start on the development side. Because we have plenty of examples to look at regarding the live, work, play dynamic and where it works, and in the absence of it, how much pain can be endured.
I want to get your take on, so Walgreens, CVS, Rite Aid, right? That model seeming to struggle and be going through a little bit of a shift right now. There's a lot of dark assets on the market. Where's the opportunity in those potential spaces for, a lot of these single tenant, triple net type of models that, maybe the corporation is going through some restructuring, bankruptcy, or just maybe consolidating footprints and maybe shifting their model a little bit? Is there any opportunity from your perspective in repurposing and reutilizing those types of old bank buildings or old CVS or Walgreens? What are your thoughts on those spaces?
Yeah, that adaptive reuse is definitely an opportunity, and but it's more difficult than building new. We spent quite a bit of time at Walgreens looking at what we call splitting the box, and unfortunately, the prototypical 14,000 square foot box was built for a single use. So if you were to drop a wall and create two 7,000 square foot spaces, you'd almost have to replicate all the mechanical, electrical, plumbing. It wasn't designed to be split, and therefore it's very expensive to do that.
Yep.
Now, what has Walgreens done with a lot of that excess real estate? Well, when I was at Walgreens, we became the largest single landlord to Dollar Tree. Turns out that my friends at Dollar Tree liked getting the corner of Happy and Healthy at 60% off, 70% off in rent, right? So they could backfill very easily. I think there's older assets where it's going to start to make sense to scrape and rebuild,
Okay.
and come out of the ground with a proper multi-tenant building that has coffee. We're seeing a lot of different coffee concepts, not just Starbucks, but Dutch Bros has been prolific, doing really well. Got breakfast places like First Watch. You have lots of, and then sort of the service, the hair cutteries that fill in as well. So I think those are going to be some opportunities. Part of the problem is the carry costs that these corporations have on the assets, and they're functionally obsolete, yet they're still being carried at a certain level, and so huge write-offs would be required in order to mark them to market and make it to where it makes sense for an investor like us to step in. I mean, we could talk for a long time around the pharmacy industry and the challenges there, but I always thought that being that last mile and having a better integration with omnichannel could have been exploited even more than it already was. There's a little bit around. There's a FedEx drop off, and maybe there's an Amazon, the lockers and things of that nature, but it was never fully exploited. It was just sort of tested here and there.
Yeah, that's interesting.
Yeah.
What if you were to set up a fund and go and look at doing an investment model at scale?
Mm-hmm.
What would you do? And or what are some of the good funds and PE groups that are great at creating value and yield doing with their capital in the commercial real estate space at scale right now and or moving into the future?
Yeah, I mean, one I can think of is called Essential Growth Properties. It's run by my friend Nick Hodge, who was the former head of real estate at Kroger. Full disclosure, I'm an investor in funds 1 and 2, but I love what he's doing, and I love what the team is doing there. And they're really focused on acquiring daily needs grocery anchored centers, and then repositioning the shadow retail. Really updating the outlots, putting the necessary capex into the centers where previously, whether it was the old owner of the center or it was the actual retailer themselves that was really piling up deferred maintenance. The one thing I'd suggest to your investors, your listeners, is to really, if you're looking to buy a Walgreens, and really look deep into the deferred maintenance that's there. Parking lot, roof, HVAC. When's the last time it was power washed and painted? And unfortunately, you have a company like Walgreens that had a capex budget of about $1 billion a year, which is now slashed to about $100 million a year, right? So it's a tenth of what they should be spending in the stores that they're not spending. So anyway, so that's one. I likewise am looking at consumer necessity retail, grocery anchored retail, and adjacent for me is very important. And particularly in the Sun Belt, where we're seeing the demographics changing. So that's a keen focus for me. What I'm comfortable with, what my background is. I've had opportunities to look at office buildings in the Loop in Chicago, and someone's going to make a lot of money who has a lot of oxygen and a lot of patience. This is how Sam Zell made his billions, right? He was the grave dancer. When a market was down, he swooped in and was brilliant at it, and then everything turned around and he sold. And you do that 3 or 4 times.
Yep.
You'll do okay.
Yeah.
So
what are your thoughts around this trend and almost necessity for consumers to have more of an experiential dynamic with their consumerism experience now? And what are some of the great operators or investors thinking about and strategizing on in order to incorporate some of that or address some of that in their commercial real estate assets, and how that's actually not only making them an outlier in a great way, but it's actually creating more value for their real estate asset? What are you seeing out there?
It's going from a nice to have differentiator to a table stake, where in the retail segment, you have to know your customers, right? And there's an old adage that our customers or consumers are telling us everything we need to know.
Mm-hmm.
The question is, are we listening? And so the operators, the retailers who listen the best, the retailers who create the experiences that create a movement, are the ones that are winning right now. I mean, you think about Lululemon, right, where people are going in there for yoga classes, right, or Nike running, where you're part of the tribe of Nike, and you're all running together at night because you meet at the Nike running store. Apple, like, who sleeps out at night in a line to get a new cell phone, right? And it's a smartphone, but they've created that following. And you mentioned this earlier too, and I 100% agree that whether you like it or not, if you're a leader of a business that's engaging in an office, you're in the experiential business now, right? You need to lead and create and foster opportunities where it makes sense to be here. The old Office Space. Remember that movie, right? With the red stapler and whatnot, Milton and his red stapler. Those days are over, where people are just going in, sitting at their assigned station, like they're robotic, and then you commute home for an hour. I think one of the things that's really important to recognize is we as a community have seen this shift from work-life balance pre-pandemic to life-work balance.
Yeah.
And so if I'm working for you, Matt, and I'm being super effective, and maybe I send 5 emails, 3 of which drive revenue for our concern. Do you care if I'm hitting golf balls in the afternoon, or compared to maybe someone else that calls you up and says, "Hey, I just sent 100 emails today. I was really productive." And I make this distinction in the book between being productive and effective. And in the new collar economy, in this keyboard economy, where we're dealing in ideas and advice and deals and so forth, I think productivity loses a lot of luster. And I think it's about being effective, meaning, is what you as an employee are doing, is it accretive to the company's mission? Is it accretive to the company's bottom line? And if we start replacing managers with leaders who are focusing on effectiveness rather than productivity, we're going to see better outcomes. I think there's an opportunity in terms of design of office space to make it more welcoming. I think it's vital that they're healthier spaces. We learned about airborne viruses. All of us are now epidemiologists, right? We know what MERV filters are and everything, but the old office buildings had fresh air exchange of maybe once or twice an hour, right? Now we need 4 or 5. We just know that creates a healthier environment. So it's gotten more complicated, but again, I just think it's a matter of really being responsive to people and understanding how they can be as effective as possible doing what they can. Again, my take on hybrid work is similar to omni-channel retail, right? It's 15, 20%, maybe a little bit more in hybrid, but it also depends. And I think we get caught up in these, in this reductive thinking and wanting to have the silver bullet. Like, okay, what's the answer? And one size fits one size. So teams will have different, they'll have different parts of the year. They'll have different challenges, different seasons. Sometimes they'll have to be in 6 days a week. right? Just because that's what you have to do.
Yeah.
And then there's other times when you need someone to have some clear headspace and, spend time in nature, hike, come back with a good idea. So, I just think we can't be as rigid as we were 20, 30 years ago.
Flexibility is key, especially now more than ever. I think you definitely drove that point home. Yeah. As we wrap up, Joe, let's circle up on that final question, which is, based on what and what we've seen play out over the last few years and what's currently in the equation, what could be in the near future. What are your predictions on the next big disruptor in commercial real estate?
Quantum computing.
Tell me more.
And so there are a couple of quantum computers out there, probably more than a couple. I know there's one pretty impactful one at the Cleveland Clinic that was built by IBM in collaboration. But we are on this path for the next big disruption, and it will be quantum in my estimation. And what just to give you a sense of the power differential, there is a company called Atom Computing that's building a 1,000 qubit quantum computer that will be 1 billion times faster than classical computers that operate on ones and zeros. And when you get smaller and into the quantum world, we're no longer talking about a switch between a 1 and a 0. We're talking about the continuum between 1 and 0, right? So it's going to upend basically everything. Cryptography, cybersecurity is all based on massively complicated math problems that take classical computers upwards of 200 years to solve, right? It's like really tough to crack that code. Not impossible, but tough. In a quantum world, that equation could probably be solved in 4 minutes or something, right? So that's an overarching technological platform shift that's going to impact all of us. And then, what will the results on commercial real estate be? I just hope that from an office sector that there is more what I'll call choice architecture in addition to the traditional architecture. I think we're going to see this massive emergence of behavioral science and behavioral economics coming in, where we have choice architects that are kind of nudging people, to do the right thing. And it's a whole area of social science that's been emerging. And so how do we help people make choices which in the long run will be really good for them and then good for the enterprise? Some examples of that are like forced savings plans, like a 401k.
Yeah,
opting in. I think there could be choice architects could be developing intramural nudges. They could be developing healthy nudges, right? If coming in and working out, exercising, eating better. Clearly, if you look around any airport, and I was just in 2 this morning, there's a lot of really large people that,
yes,
now that Ozempic, GLP-1 drugs are all the rage, that's mind-numbing. So anyway, those 2 things. I'll go with those 2 things. So look out for more nudges coming from choice architecture, and then keep an eye out on quantum computing.
I love it. Joe Brady, it's been a pleasure having you on today. If you guys enjoyed this conversation, you guys are definitely going to enjoy Joe's book, Workshop. We'll link that up in the show notes. And if people want to know more about you, they want to follow your content, get the book, where's the best place for them to connect with you?
Sure. The best place is joebrady.ai. So that's my webpage. Go there, access to my LinkedIn, speaking engagements, things that I've written, and you can access an Amazon link to buy the book there as well.
Joe, thanks for coming on the show.
Thank you very much.